Hi, and welcome back to the Food Fund, where we analyze investing in food stocks. If you love food and love buying food stocks, beverage stocks, and restaurant stocks, you will love this channel. In this video we will be analyzing if Sweetgreen stock is a buy. Sweetgreen, stock ticker symbol SG, is a popular salad chain restaurant that has received a lot of media attention recently. If you are new here, our goal is to help you put your money where your mouth is and invest in the best food companies. We have a lot to cover, so let's go ahead and jump right in. Cue the logo. Let's start with some background info on Sweetgreen. Sweetgreen was founded in 2007 by 3 Georgetown University students with a mission to make healthy food accessible and convenient. Focusing primarily on salads, the restaurant offers a wide variety of customizable ingredients, alongside other healthy options like soups, grain bowls, and seasonal offerings. The company went public in 2021 and has rapidly grown ever since. Today the company is headquartered in Los Angeles, California and has 2,000 employees across their growing chain of restaurants. Now let's look at the price action. Starting with the 1-year chart, we see that Sweetgreen had a CAGR of about 23%. Zooming out to the 5-year chart, we see that Sweetgreen has been public for less than 3 years and has a CAGR of -48%. Sweetgreen's share price has suffered a long downtrend but appears to be skipping along the bottom now. If we perform a backtest comparison of investing $10,000 in Sweetgreen versus the S&P 500, we find some bad results for Sweetgreen. In that comparison with the S&P 500, $10,000 invested in Sweetgreen would have fallen to $3,338 or a -41% CAGR versus $10,490 or a 2% CAGR if invested in the S&P 500. This demonstrates tremendous underperformance for Sweetgreen. Unsurprisingly, a Sweetgreen investment would have been more volatile with a 73% standard deviation versus 20% for the S&P 500. While Sweetgreen outperformed the S&P 500 in terms of the best year performance, for which Sweetgreen grew 32% versus S&P 500 26%. The company underperformed on worst year performance, where Sweetgreen fell 73% versus the S&P 500 18% fall. In terms of max drawdown, Sweetgreen fell 76%, about 3 times more than the 24% drawdown for the S&P 500. Sweetgreen also underperformed the S&P 500 in comparisons using the Sharpe ratio and the Sortino ratio. Now let's hop over to market share and take a look at Sweetgreen's market share. Here we have the dashboard, where we can quickly gather a lot of information at a glance. Expanding the dashboard, we can look under restaurants and see that Sweetgreen is categorized under fast food restaurants. Expanding the fast food restaurants tab, we can see that Sweetgreen has the 4th smallest market share. However, the green hue lets us know that the market share is growing. Let's look closer at the year-by-year changes in market share. So we come over here and type in the ticker symbol for Sweetgreen and see that the market share is 0.05% out of the publicly traded food, beverage, and restaurant stocks currently in the market. This is very small market share, but it is growing. The 5-year market share CAGR for Sweetgreen is 11.3%. This means that Sweetgreen is taking market share from other companies in the food and restaurant space. If we start in 2019, we see that the market share was 0.036%, 0.029% in 2020, 0.038% in 2021, 0.047% in 2022, and rose to 0.054% over the trailing 12 months. Though the market share took a hit in 2020, we can clearly see that more and more spend is going to Sweetgreen every year since. Let's take a look at the fundamentals. Gross margin is 17%. This is a bit worse than typical fast food restaurants. Revenue has compounded at around 20% over the past 5 years and has reached over $550 million most recently. Whoa. People love their salads. Looking at cash flow, we see that operating cash flow just barely flipped positive over the trailing 12 months, while capex has worsened at a 30% CAGR. As a result, free cash flow has worsened at a 9% CAGR. Though operating cash flow is now positive, capex is continuing to grow. The good news is that free cash flow hit its low point in 2021 and has been improving nicely every year. Weighted average shares outstanding have grown since the company went public, going from 110 million shares in 2022 to 112 million shares most recently. Sweetgreen has been busy diluting shareholders. The good news is that the pace of dilution is relatively slow at an almost 2% CAGR. Now let's view return on invested capital. Return on invested capital has risen from -59% in 2021 to -30% in 2023. A negative return on invested capital means that the company is not profitable but has been moving closer every year. Another favored metric is cash conversion cycle, a measure of operational efficiency regarding supplier and payer leverage as well as inventory control. Going from -8 days in 2020 to -2 days most recently, Sweetgreen has gotten less efficient over time. While it is good that the cash conversion cycle is negative, the upwards trend is worrisome. Now, let's look at Sweetgreen's debt. The net debt to EBITDA has fallen over the past 5 years, going from 4.8 in 2019 to -0.3 most recently. Again, since Sweetgreen is unprofitable, this means that the company holds debt on its balance sheet. The fundamentals of Sweetgreen are pretty mid. In any event, should it be added to the portfolio? Before sharing my final thoughts on that, please click the like button and let YouTube know that you like the content. Subscribe and click the notification bell to make sure you catch the latest videos. Your continued support means so much to the Food Fund. Now, let's get into my final thoughts. Okay, let's go to the spreadsheet and write out some key values for Sweetgreen. It is a restaurant company with a gross margin of 17%. The revenue per share CAGR is -29% and the free cash flow per share CAGR is 36%. While the gross margin is thin and revenue diluted by rising share count, free cash flow growth is good. A return on invested capital of -30% is bad because it is negative, but it is moving closer towards positive every year. Next, the cash conversion cycle of -2 days is great, but this value has been worsening over time. Concerning debt, a net debt to EBITDA of -0.3 means that Sweetgreen has debt and isn't profitable. So from a fundamental standpoint, Sweetgreen has a few positives and many negatives. Now let's switch our attention over to valuation. Given that Sweetgreen is unprofitable, its value relative to the S&P 500 is -0.3. The price to earnings growth, or PEG ratio, is unable to be calculated because the company is not profitable. Sweetgreen is just one among the many newly public restaurant companies. However, it is getting a few things right. Market share and revenue are growing, indicating that consumers like the product. Operating cash flow has just peaked positive, which should continue to improve if margins at least hold. My first concern is the ever-increasing amount spent on capex, presumably to build out new locations. If the company overbuilds, then they will drain all of their cash into an investment that will never have a return. However, if they underinvest, then they leave future market share on the table. The current trends indicate that Sweetgreen could become free cash flow positive within the next 2 years. This is important because Sweetgreen has enough cash on hand for a little over 2.5 years operating runway. Management has plenty of time to get this right without taking on more debt or aggressively diluting shareholders. The first sign of caution for me would be slowing revenue growth. If consumers start to pull back on buying $15 salads and $18 protein plates, Sweetgreen might run into trouble. I also think the salad concept is undifferentiated. Alfalfa, Just Salad, and Chopped are all restaurants that offer a very similar menu. Additionally, many grocery stores and delis offer salads. Despite this, I am curious if management can avoid additional fundraising. For now, Sweetgreen is going on the watch list. Many thanks for watching. What do you think about Sweetgreen and their journey to profitability? Please share your thoughts below. It is always great to hear from you. Please check out some more videos right now and don't forget to put your money where your mouth is.